Today we're going to pull back the curtain on a part of the financial world that used to be totally off limits unless you were super wealthy. We're talking about something called private credit, and it's suddenly becoming available to a lot more people, maybe even you.
So let me just start with a question. What if you could invest your money the same way a huge pension fund does? Get access to the kinds of strategies they use to generate that steady, reliable income? For a long, long time, that was just a fantasy for most of us. But things are starting to change right now.
So what in the world is private credit? Well, when you boil it down, it's actually pretty simple. It's when investment funds, not banks, lend money directly to companies. Think of it like a private version of the bond market. For years, this was a really exclusive club. But now, those doors are swinging open.
Okay, so why is this all happening now? What's the big deal? Well, it turns out there are really 3 different groups of people, and they all have their own reasons for jumping into this market.
First, there's you, the investor. In a world where the stock market can feel like a roller coaster, you're probably looking for other ways to make your money work for you. And private credit, well, it often offers higher interest rates than the bonds you might normally buy. Plus, it's a way to add some diversification, because these private deals don't always zig and zag with the public markets.
Then you've got the giant asset managers, the big names. They are always on the hunt for more capital to manage, and they've spotted this huge, untapped resource, trillions of dollars sitting in the accounts of individual investors just like you. So they're creating these new funds to bring that money in and, of course, fuel their own growth.
And finally, you have the companies themselves. See, big banks are facing more regulations, and sometimes they're a little slower to lend. So businesses need other places to get cash, and that's where these private credit funds come in. They can often provide loans that are way faster and more tailored than what a traditional bank can offer.
Okay, so I get why everyone's interested. But how does it actually work? Like if you put your money in, what happens to it? Let's follow the journey from your account to a business and then hopefully back to you as income.
The whole process is actually pretty straightforward. It starts when you invest in one of these specialized funds. They're often called evergreen funds. Then, the fund manager takes your money and pools it with thousands of other investors. With this giant pot of capital, they go out and lend it directly to different companies. Those companies, in turn, pay interest on their loans back to the fund. And then finally, the fund pays out that interest to you, usually as a regular income stream. Now, this is really important. Anytime you hear about higher potential returns, you've got to know there's more risk involved. And with private credit, the risks are just different from what you might be used to with regular stocks or bonds. You absolutely need to understand the trade-offs here.
The biggest, number one difference comes down to a single word: liquidity. That's just a fancy way of saying, how fast can I get my money back? If you own a stock, you can sell it pretty much instantly. But a private credit fund, that's a whole different ballgame. You usually have to put in a request to get your money out, and they might only process those requests once a month, or even once a quarter. And, this is critical, there are almost always limits on how much you can pull out at one time.
And it's not just about getting your money out. You also have to think about default risk. That's the very real chance that a company they loan money to just goes out of business. Then there's valuation. Since these loans aren't traded on an open market, their value is just an estimate made by the fund manager. You also have to look out for something called payment in kind, which is when a company pays its interest with more debt instead of actual cash. That can be a serious red flag. Really, it all boils down to this. You are placing a massive amount of trust in the skills of that one fund manager.
So, let's wrap this all up. We've talked about the good, the bad, the tricky. What does this all actually mean for you and your portfolio? How should you think about this? Look, private credit can be a really interesting new tool in your toolbox. It could be a great way to get income and diversification. But, and this is a big but, it is not a replacement for your savings account or your emergency fund. Because your money is tied up, you have to go into this with a long-term mindset. This is an investment you make for the yields, and you have to be okay with the fact that you can't just get your hands on it tomorrow.
And that really brings us to the final question you have to ask yourself. For the very first time, this type of investment is available to almost everyone, offering a kind of income that used to be out of reach. But it comes with a major trade-off. You get those potentially higher returns, but in exchange, you have to lock up your money. The opportunity is definitely here. The only question left is your portfolio ready for that trade-off?